Layer 1s and 2s explained, everything you need to know. In the world of blockchain and cryptocurrency, few topics are as essential, and as misunderstood, as Layer 1 and Layer 2 technologies. These layers form the backbone of how decentralized networks operate, scale, and interact. Without understanding what these layers are and how they differ, it's nearly impossible to grasp how Ethereum works, why Solana is fast, or how scaling solutions like Arbitrum and Optimism are changing the game. Whether you're an investor, developer, or simply curious about crypto, understanding Layer 1s and 2s is your gateway to making sense of the entire ecosystem. Before we begin, an important message: cryptoassets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. At its core, a Layer 1 is the base blockchain, the foundation that processes and validates transactions. Think Bitcoin, Ethereum, Solana, or Avalanche. These are standalone networks with their own consensus mechanisms, token economies, and infrastructures. Layer 2s, on the other hand, are built on top of these base layers to improve scalability, reduce costs, and increase throughput without compromising the security or decentralization of the underlying chain. They're the upgrade kits to the original architecture, designed to handle the explosive growth of users, apps, and data. When people say Ethereum can't scale, they're really talking about the limitations of Layer 1. Layer 1 networks often face a trade-off between decentralization, security, and scalability, known as the blockchain trilemma. Bitcoin prioritizes security and decentralization but sacrifices speed. Ethereum tries to balance all three but still suffers from congestion and high fees. That's where Layer 2s come in, to take the pressure off the main chain by handling transactions in a more efficient and cost-effective way, then settling back to the Layer 1 periodically. The reason this layered architecture is so important is because of how blockchain networks have evolved. In the early days, Bitcoin proved that a decentralized network could be secure and trustless, but it was slow and limited in functionality. Then came Ethereum, introducing smart contracts, self-executing programs that could support decentralized apps. But Ethereum quickly ran into scalability issues. Every transaction had to be processed by every node, leading to slow speeds and skyrocketing gas fees as demand grew. This bottleneck set the stage for Layer 2 innovation. Layer 2s solve this by moving most of the computational load off-chain while keeping the security guarantees of the Layer 1. One of the most popular approaches is rollups. Rollups batch many transactions together, execute them off-chain, and submit a compressed proof back to the main chain. Optimistic rollups like Optimism and Arbitrum assume transactions are valid unless challenged, while zkRollups like zkSync and StarkNet use cryptographic proofs to verify correctness instantly. Both methods drastically reduce costs and increase speed, making apps cheaper, faster, and more user-friendly. This isn't just theoretical. Major D apps like Uniswap, Synthetics, and Aave are already migrating to Layer 2s or launching new instances there. The user experience improves dramatically. Instead of paying $20 in gas for a token swap, users might pay a few cents. Transactions confirm in seconds rather than minutes. And for developers, the ability to build at scale without compromising on decentralization opens up possibilities that were previously unviable. The rise of Layer 2s is arguably the biggest usability leap for Ethereum since its inception. It's not just Ethereum that faces these challenges. Every Layer 1 blockchain has to contend with the trilemma. Solana, for example, offers blazing fast transaction speeds and low fees, but it does so by making different trade-offs, such as higher hardware requirements and lower decentralization. Avalanche uses a novel consensus mechanism and subnet architecture to scale, allowing for customizable chains. Each Layer 1 tackles scalability in its own way, but none are perfect. That's why we see so many Layer 2s being built even for Layer 1s other than Ethereum. Polkadot and Cosmos take a slightly different approach. Rather than scaling with Layer 2s, they focus on interoperability, connecting multiple Layer 1 chains together in a network of networks. Each chain can be optimized for different use cases, and tokens or data can flow between them. In this model, scalability comes from horizontal expansion, more chains, each handling different workloads, instead of vertical stacking through Layer 2s. These architectures blur the line between what is a Layer 1 and what is a Layer 2, offering yet another route to solving the same underlying issue, performance under pressure. But for Ethereum specifically, the roadmap is crystal clear. The future is rollup-centric. Ethereum's core developers have made it clear that scaling will come primarily through Layer 2s, with the base layer focusing on decentralization and security. Ethereum 2.0 upgrades like proto-danksharding and full sharding will eventually make rollups even cheaper and faster by increasing data availability. In this model, the Layer 1 becomes a highly secure, decentralized settlement layer, while the Layer 2s handle the day-to-day user activity. Understanding the relationship between Layer 1s and Layer 2s also requires examining their economic structures. Layer 1s typically have their own native tokens, like ETH, SOL, or AVAX, used to pay for gas, incentivize validators, and secure the network. Layer 2s may have their own tokens too, like OP for Optimism or ARB for Arbitrum, but their value is often tied to how well they scale and serve the Layer 1 ecosystem. In this sense, the success of Layer 2s is symbiotic. The better they perform, the more useful and accessible the base chain becomes, and that, in turn, boosts adoption and network value. This is also where governance and decentralization come into play. Many Layer 2s start off centralized, run by a single company or foundation, before slowly handing over control to a DAO or validator network. This gradual decentralization is often necessary to ensure stability during early development, but it raises questions for users and investors about long-term trust and resilience. Projects that are more transparent, open source, and community-led tend to build stronger reputations and attract more sustained adoption. Security is another critical component. Since Layer 2s inherit their security from the underlying Layer 1, they are often seen as secure by default. But there are risks, especially in bridging, fraud proofs, or poorly designed smart contracts. Hacks and exploits have already occurred in several scaling solutions. This makes auditing, insurance, and responsible disclosure essential. As Layer 2s handle billions in value, they must meet the same security standards as their Layer 1 parents, or risk losing user trust overnight. Bridges play a unique role in connecting Layer 1s and Layer 2s, allowing users to move assets between chains or layers. These bridges are essential infrastructure but have also been prime targets for hackers. Billions have been lost due to bridge vulnerabilities, making them one of the riskiest components in the crypto stack. That said, newer designs, including native bridges built directly into rollup architectures, are starting to show more promise. Security-first development, multi-sig wallets, and modular bridge solutions are now top priorities for developers aiming to reduce these attack vectors. Another interesting trend is the rise of application-specific Layer 2s, chains built for a single DApp or platform. For example, DEED has moved to its own chain built on Cosmos SDK, and other DeFi projects are exploring rollup as a service models to customize performance and UX. These custom environments allow projects to control every aspect of the user experience while still anchoring to Ethereum's base layer for security. This approach is becoming more attractive as competition grows and user expectations rise. Projects want faster, cheaper, smoother interfaces, and general-purpose Layer 1s can't always deliver that. From a developer perspective, Layer 2s also offer new opportunities and challenges. Developing for a Layer 2 usually means using the same programming languages as Ethereum, Solidity, Viper, but with slightly different tooling, environments, or gas models. For example, deploying to Arbitrum or zkSync might require customized deployment scripts or new wallet integrations. As more infrastructure and dev support is built out, however, the barriers are falling. In fact, many developers now choose to launch directly on a Layer 2, skipping the mainnet entirely. From the user perspective, the benefits of Layer 2s are most noticeable in cost and speed. For years, Ethereum gas fees were a major barrier to entry. A single swap could cost more than the actual value of the trade. But with Layer 2s, those costs are slashed dramatically. Instead of spending $20 to send tokens or interact with a contract, users might pay just a few cents. This makes crypto far more accessible, especially for users in developing countries or those with smaller portfolios. It also paves the way for more microtransactions, new business models, and creative experimentation. Wallets and exchanges are adapting too. MetaMask now supports Layer 2s natively, and centralized exchanges like Coinbase are investing directly into scaling solutions. Coinbase even launched its own Layer 2 called Base, built on the Op stack, to give users faster and cheaper access to Ethereum-based assets. These moves show how mainstream players are betting big on Layer 2 infrastructure, not just as a convenience, but as a fundamental part of crypto's future. More seamless Layer 2 integrations mean users won't even have to think about which layer they're on, they'll just enjoy faster, cheaper experiences. Beyond Ethereum, Layer 2s are also evolving to serve other ecosystems. While Ethereum is the clear leader in Layer 2 activity, networks like Bitcoin are exploring similar scaling concepts. The Lightning Network is essentially a Layer 2 that enables instant, low-cost BTC transactions using off-chain payment channels. Though different in design from rollups, it serves the same purpose, making a Layer 1 more usable. And in the Cosmos and Polkadot ecosystems, developers are building modular chains that mimic Layer 2 functionality by offering customizable performance layers. As the space evolves, modularity is becoming a buzzword in Layer 1 and Layer 2 design. Instead of building monolithic blockchains that try to do everything, many projects are now decomposing the stack into modular components: consensus, data availability, execution, and settlement. Projects like Celestia are pioneering this approach, offering a Layer 1 focused solely on data availability while leaving execution to higher layers. This opens up the door to more flexible, efficient systems where developers can pick and choose the components that best fit their needs. This modular approach also redefines what we mean by Layer 1 and Layer 2. In traditional terms, the distinction is clear: a Layer 1 is the main chain, and a Layer 2 is built on top. But with modular architectures, these lines blur. A project might use one Layer 1 for security, another for data, and a Layer 2 for execution. This multi-layered, composable model is what many refer to as the modular blockchain future, and it could be the key to solving blockchain's biggest challenges without forcing everyone into a single design paradigm. It also means Layer 2s could become more specialized over time. Instead of general-purpose rollups, we may see niche Layer 2s optimized for gaming, DeFi, social apps, or identity solutions. Each one could be fine-tuned for the needs of its specific vertical, much like how Web 2 evolved from generic platforms to highly specialized services. These ecosystems will likely interconnect through bridges, cross-chain messaging, and universal wallets, giving users a seamless experience across a fragmented but interoperable Web 3 landscape. As these technologies mature, another major area of focus is user onboarding. For Layer 2s to reach mainstream adoption, the experience must be seamless. Users shouldn't have to worry about bridges, gas tokens, or network switches. They should be able to use a D-app just like any Web 2 app, fast, smooth, and intuitive. That's where smart wallets, account abstraction, and infrastructure like Wallet Connect and WebAuth come in. These tools are helping abstract away the complexity of interacting with different layers, making Web 3 as easy to use as signing into an email account. On the investment side, understanding Layers 1 and 2 can give you a massive edge. While many retail investors focus only on Layer 1 coins like ETH or SOL, the real alpha may lie in the Layer 2 projects that power scalability. Coins like OP, ARB, or upcoming rollup native tokens could see substantial growth if adoption continues. And because Layer 2s often have smaller market caps and more room to grow, they represent asymmetric opportunities, albeit with higher risk. As always, doing deep research and understanding the underlying tech is crucial before investing. Layer 1s also continue to evolve in response to Layer 2 growth. Ethereum's developers are actively working on upgrades that will make the chain more rollup friendly. Concepts like danksharding and EIP 4844, proto-danksharding, are designed to make data availability cheaper and more efficient, a vital component for rollup performance. The better Ethereum supports rollups, the more powerful and scalable the entire ecosystem becomes. This shows a rare alignment between Layer 1 and Layer 2 goals, working in harmony rather than competition. This alignment between Layer 1s and Layer 2s is perhaps one of the most unique dynamics in all of crypto. Traditionally, scaling solutions in tech often compete, newer platforms displace the old. But in crypto, Layer 2s don't replace Layer 1s, they enhance them. They extend the reach, reduce the costs, and multiply the possibilities. Ethereum's roadmap explicitly embraces this relationship, making it clear that the Layer 1 will become the settlement and coordination layer, while rollups and other scaling solutions become the user-facing experience. This dual-layer structure mirrors the way the Internet evolved. At the core is TCP/IP, a foundational communication protocol that most users never think about. On top of that are services, apps, and platforms, the web we interact with every day. Blockchain is undergoing the same shift. The Layer 1 is like TCP/IP, robust, secure, foundational. The Layer 2s are the user apps, dynamic, diverse, and responsive to real-world demand. The result is a layered stack that's optimized for scale, without compromising on the values that make blockchains powerful in the first place. It's also worth noting that the terminology around Layer 2 is beginning to evolve. Not all scaling solutions fit neatly into that definition. Validiums, sidechains, upchains, and even data availability layers all contribute to the scalability landscape, but they vary in how much they inherit from the base layer. Some are more centralized, others more modular. As the ecosystem expands, experts and builders are beginning to think less in terms of rigid layers and more in terms of modular functions. What service does this component provide, and how secure or interoperable is it? Looking ahead, the evolution of Layer 1s and Layer 2s will likely shape the future of decentralized applications, finance, identity, and even governance. As chains become faster and cheaper through rollup technology, we'll see more mainstream use cases emerge, from Web3 games that don't lag, to social platforms with built-in crypto incentives, to real-world asset markets operating entirely on-chain. None of this is possible at scale without efficient, secure, and composable layers. And that's exactly what Layer 2s enable. For developers, the future means more flexibility, lower costs, and better tooling. Instead of being locked into a single chain, they'll have options to launch on a general-purpose Layer 2, spin up a custom upchain, or build modular systems that combine the best of both worlds. For users, the difference will be invisible but transformative. Gas fees will be negligible. Transactions will feel instant. Crypto will finally behave more like the Internet, fast, simple, and always on. This is the promise of the layered blockchain future. For investors and analysts, understanding the differences between Layer 1s and Layer 2s, and the projects building in each category, is crucial. It's not just about who has the fastest chain or the cheapest fees. It's about who's building for the long term, who's aligned with Ethereum's roadmap, who's enabling real adoption. Whether you're bullish on Arbitrum, Optimism, Base, Starknet, or something else entirely, the one thing that's clear is this: the future of blockchain will be layered. In a world increasingly driven by digital infrastructure, knowing how Layer 1s and Layer 2s interact is no longer optional, it's essential. And now, you understand how it all fits together. Subscribe to CryptoPulse for deep dives, tutorials, and objective insights into crypto's biggest trends.